Hello, with me today I have John Meyer, mining analyst at SP Angel. Hi John, great to talk again.
Hi there.
What a year 2022 has been so far. It's been a year of extreme volatility across investment sectors and global regions. What are the major themes moving the mining sector right now?
There's a lot of negative stuff going on at the moment. Clearly the world looks like it's slowing, according to many of the headlines. The US dollar is very strong. There's a war in the Ukraine, let's not forget that. There's a degree of inflation in the world. There's a bit of demand destruction, possibly some of that in China and elsewhere. The UK is not looking like such a happy place right now. But it's interesting because remember, the US is growing. The reason why the Federal Reserve says it's raising interest rates is because they have a lot of inflation, and they have that inflation because they stimulated a whole heap of growth. And so that growth is creating demand, is creating demand. But because the outlook is not so good, because policymakers have said we're going to slow things down, because the Federal Reserve says that it's going to continue to raise interest rates, because money is flowing out of capital projects and into US dollar treasuries, that is slowing everything down. It's more a sentiment thing in my view than actually a real economic crash. But unfortunately, sentiment drives everything. And there's also a degree of push and pull in terms of restocking and destocking. So because there were so many logistical issues going on in the world, problems with shipping, problems with because of COVID, getting ships in and out, and there were problems within logistical chains, semiconductor chips, other components, that sort of stuff. Manufacturers did a lot of restocking, and because now the outlook is not so good, sentiment has gone kind of negative. There's a degree of destocking going on, and what this means is markets always overshoot. They overshoot on the upside. We certainly saw that, particularly in the tech market, and now we're overshooting on the downside in my view.
I mean, what about China? I mean, how big a problem do you think China and Chinese demand is at the moment?
Chinese demand is likely to be falling. I mean, it looks likely that they'll miss their quarterly GDP targets. It looks like China is going to slow quite a lot this year. But we've been watching China for many years now, and it's extraordinary how resilient they normally are. Now, I don't think they're going to be as resilient this year as they have been in the past. The zero COVID policies that they are sticking to are still causing business interruptions within China. And let's not forget that the weather is a big thing in China as well. They had flooding, then they had drought, they had excessive heat, and of course zero COVID on that, where there were lots of these guys locked up. But despite those zero COVID restrictions, they still had lots of manufacturers still able to work. In fact, in many cases, workers were locked in at the factories. They were sleeping there. In fact, there were a few riots that happened as a result, because you don't really want to be locked into your workplace for 3 months at an end. Your workplace suddenly becomes a bit like a prison camp. So China hasn't been damaged as much as it might be. But yes, certainly the rate of growth is likely to slow. They have problems with their construction industry, with the refinancing of debt there. And one of the big things about the US dollar getting strong and US interest rates going high is it's sucking money out of China and many, many other countries. That money is coming out of projects. Manufacturers are also moving and reshoring back to the United States. And that's creating a liquidity crisis. So it's got very difficult for property businesses to refinance what they're doing. And that's led to problems in China, where 200,000 to 300,000 people stopped paying their mortgages, but they were paying mortgages on houses that they hadn't moved into. So it's a little different from the UK and the US, where you normally only start paying the mortgage when you actually move into the property. In China, you start paying even though the property hasn't been completed by the developer. And in many cases, I think this was 6 months or over a year, and those developers simply weren't getting on with the job, and therefore it's kind of, the new owners had every right to say, well, why should we pay a mortgage on this? We're not able to move in. Please get on and finish the job. So the Chinese government has changed the rules a little bit, so they've got the finance to refinish these apartment blocks, and hopefully that will help to get things going again. It's not helping new construction at the moment. So steel prices are starting to fall, iron ore prices should fall, and things are slowing in that respect.
Metal prices have been mixed over the year, but big declines in copper and iron ore grab the headlines. What's been going on? Do you think prices are likely to fall further? I know you say sort of prices do sort of tend to overshoot, both ways, on the upside and the downside. But what's the outlook for prices?
Well, as I say, I think the construction sector in China, which is a really big part of their economy, it's somewhere around 40% of what they do, is having a tough time. We would expect a number of new government projects, big infrastructure projects to come in, maybe the acceleration of some of that. So, but even having said that, we would think prices for rebar steel, construction steel, probably likely to pull back. A little less of that in also a softening of prices for iron ore, for example. But of course, we have an energy crisis in the world at the moment, clearly caused by what's going on in Russia, and a catch up of demand pushing oil prices ahead, particularly. So it's not just all about Ukraine. It's about the creation of demand as the world comes out and came out of COVID. I mean, the US and Western Europe is not really in COVID anymore, although case rates are rising. In fact, I noticed mortality rates in Germany are about 10 times what they are in the UK for COVID. But we have the feeling that's tied into the Oktoberfest beer festivals. So there are things like that going on, but we're not looking at lockdowns in the Western world because mortality rates are still relatively low, and we've kind of got over it in many respects, even though it's still having, there's a certain amount of flu around as well, which isn't great for everybody. But the point is, yes, coal prices are elevated for now. There is a certain amount of softening on other metals, but I think so much of it is sentiment driven, and some of that's destocking. But if you look at the London Metal Exchange, and you look at COMEX, and you look at Shanghai SHFE, their stock levels are very low. And now we have a situation where it's toxic to buy Russian metal. Nobody wants to touch that. So we expect a bit of stock building, particularly in aluminium and copper, where Russian metal will sit in warehouses, but no one will be able to touch it. But in the meantime, other metal is becoming less available. And I think at some point, the prices that have been falling are going to turn around and go up. And I certainly would expect to see that in the new year, and probably before that, maybe towards the end of November. Now, we have to remember that in December, hedge funds tend to start to square their books and reduce their risk. So the moves that are going to happen are going to be in November and then in January. That's what we're really looking for. But sometimes what you find is these things start to creep ahead in December.
Okay, you mentioned coal. I mean, the price has doubled in value in 2022 so far. And again, you mentioned the energy crisis, and it's had a massive impact. I mean, that's not great for the environment. But what's the story? Is this kind of price for coal sustainable, and for how long, if so?
Well, it's not sustainable in the longer term, but certainly short term, while the war goes on in Ukraine, coal prices will remain elevated because nations have to find energy. A lot of wind farms are being built at the moment, and so long as the wind carries on blowing, we'll get more and more energy from that. They had problems with hydropower, particularly in China, because there wasn't enough rain over the summer. We would expect that those reservoirs and dams to get restocked. So I think that pressure will ease, and therefore, as China has been moving rapidly more towards renewable energy, although still increasing its coal consumption. But at some point that will flip and coal prices will start to come off. It's not their intention to carry on using more and more coal, because at the end of the day, it's cheaper to generate electricity from hydropower and from wind power and solar power going forward. So I think that will really start to take over, and coal prices will certainly come back one way or another.
Okay. Well, over the past few days, weeks, we've had a number of updates from the mining sector, production updates. What are your key takeaways?
Well, there is a bit of inflation around, and the mining sector is not immune from that. Energy costs are generally about a third of the cost base of any mining company. Add labour to that and industrial reagents. They don't use a lot, but they do use a bit in the mineral processing, lubricants for machinery as well. So we've seen, I think a lot of the inflation has already come through. Let's not forget steel and also iron for the iron balls in the ball mills. So I think a lot of that has come through now, and that has certainly squeezed margins, particularly with metals prices coming down. Still, commodity prices are kind of high enough to offset that, but if you're invested in a marginal producer, life's going to get tough. Most of the companies we look at are reasonably immune from that, but we have to be cognizant of the liquidity crisis. If there's a company out there that requires the refinancing of a portion of its debt, then it will have problems. If we think back to Glencore about 6 years ago, I think we're talking about maybe 7 years ago, when they had, we go back further than that, 2008, 2009, they had a number of revolving credit facilities, and they needed to refinance that, but the world wasn't really giving out any cash, particularly that sort of cash. Now, I'm sure they won't have a problem this time around. I think they've got a more diverse debt book, and in fact, their cash flows are incredibly strong, particularly from the trading business. And remember, they're big coal producers as well. So I think Glencore still has a very good business. But any business that has debt that needs to be refinanced in the short term is gonna have to work really hard to replace that capital.
Now, you mentioned Glencore, and of course, Glencore was one of your tips for 2022 when we spoke at the end of last year. So, and it's been a great performer. So, you've given some analysis of the company already. Still one to own, and have you any thoughts about the other heavyweight miners?
I think the other heavyweights they're very interesting. Rio Tinto its cash flows will come back with what's going on with iron and copper. BHP is in a good place because it still has its oil and gas business at Woodside in Australia, so it has big benefit there. But again, it will suffer from falling iron ore prices. Glencore, I think, is still in a very good place. Its trading business is really, really well positioned for what's going on in the world at the moment. Lots of opportunities for their traders to benefit, and they have a huge coal business as well, so big cash flow off that. Yes, I think the gap between Glencore and BHP will probably soften, but I still think I'd probably hold Glencore on balance, but BHP certainly looking like it would become a good quality alternative, because that's also in the energy business.
Of course, well, you've touched slightly on the outlook earlier on when you mentioned the hedge funds. But what is the outlook for Q4? What should investors in the mining sector expect to see during the rest of this year? What should they watch out for, be wary of over the next couple of months?
It's a pretty difficult call for the end of this year, and I'm much more optimistic about next year, and should be. I think there could be quite a good run in the first quarter, and yes, as an investor, I would want to position myself before that for in my favorite stocks, for example. The issues hitting us now, well, inflation is something we know about. At some point, I think there'll be a settlement of what's going on in the Ukraine, whether that's more capitulation by the Russians or whether that's a some kind of a pitch, an agreement with Russia on certain lands out there. I'm not going to go all Elon Musk on everyone and try and force the issue. But I do think there'll be some sort of resolution there. That doesn't necessarily solve the energy crisis in Europe, but it should start to ease. The sky is not going to fall in on our heads. And I think the market, which generally looks 6 to 9 months ahead on where things are going, I think we'll start to look forward to more growth in the United States. It doesn't get talked about very much, but the US government it's enjoying the benefits of a lot of industry reshoring back into the US. That's why we've got so much jobs growth, and that's what's allowing the Fed to carry on raising interest rates. The more they raise rates, the more money pours back into the US dollar and back into the US. And America benefits from that. Yes, the rest of the world will slow down a bit, but America is such a huge economy. They are such enormous consumers of just about everything, particularly when it comes to metals consumption. And yes, I think that will be a big driver. So when we look at specific markets, let's say the vanadium market, vanadium prices have been very much higher than elsewhere in the world over the last 6 months. And I think that will continue.
Well, John, we'll be watching vanadium prices very closely. John Meyer, mining analyst at SP Angel, thanks for joining me today.